Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I am Manisha Gupta. Well, it has been a week which has seen strong gains across commodities. Let's do a quick recap of what the week was for the space. And what a rally it has been, especially for the base metal prices, where you saw the iron ore prices gain up to a 3-month highs. It has been a week where you saw the prices trade above $70 per ton as well. And not far behind was the copper prices, which saw gains coming in every single day this week. The prices are closing the week nearly at a 2-year highs. There have been supply concerns in Chile, Canada, Indonesia, and that has been supportive for the prices. Also, there have been reports on how China could ban scrap imports from 2018. And remember, the economic data from US, Japan, Europe also has been on the positive side. That is taking the prices higher. The steel prices as well extended gains, and we saw the prices trade around those 3-year highs. China has begun to crack down on low-grade steel, and that had led to concerns on supply. The other metals like nickel and zinc as well are trading at a multi-month highs. It doesn't end there, because if you look at the precious metal space, the gold prices continue to glitter as well. The weakness in US dollar at a 13-month lows and a dovish statement by the US Fed on an interest rate hike has aided this sector as well. The crude oil prices also are looking at a very strong week, up nearly 6%. It has been a 4th consecutive week of decline in the U.S. inventories. The OPEC statements have been quite positive, and you have seen the global glut situation ease a bit, and that has been supportive for that sector. Let's discuss this further with Edward Morse, who's Global Head of Commodities at Citigroup, and he joins us on the show. Edward, hi, welcome. The crude is trading at a $51 per barrel for a second straight day. Would you say that all the good news has been factored in, whether it has been OPEC or the U.S. weekly inventory decline, or are you looking at further increase in prices from here?
No, I actually don't think all the good news is factored in. In fact, there's a bit of a sell-off today, and I think that's because $50 Brent is a magic number. Some people who are very bearish still in the market think that 50 is a top, and they therefore are going short. And I think until the financial markets come to realize that we're seeing steady 2 million barrels a day drops in inventory, until that moment, I think we'll have some resistance on the upward movement of the price. The financial market participants are at a kind of record low level in terms of their market positioning as a percentage of open interest. So I think directionally, eventually, we'll have them bounce off this low level of net length, and we'll see support from the financial community as well.
Edward, I mean, as you mentioned, there are just too many moving pieces in the energy sector. There is OPEC on one side, while, of course, the meeting this week has been quite encouraging. Then there also is the shale output, which we have seen continue to gain. And then, of course, the third point is demand. What among all these three are you keenly watching out for further cues on crude?
So we're not so much focusing on demand, because we think that demand will be roughly 1,400,000 barrels a day year on year. Maybe it will be a bit higher or lower depending on weather, but it's not going to be very much different from that in all likelihood this year and next year, particularly as emerging market GDP growth, and particularly in both China and India, remain robust. So demand is not something to focus on. Rather, the immediate indicator actually on the supply side is U.S. drilling activity and the utilization rate of U.S. rigs. So there's a lag in the time between prices and where they exist and where drilling takes place. We've seen drilling being very robust, and it really peaked in terms of growth in rig utilization when oil prices peaked at $55 a barrel. It's come off considerably. We've seen the rig rate going from an increment weekly of 25 rigs to 15 rigs to 10 to 3, 4, or 5, and now last week it was actually a negative number, and that reflects a combination of where the current price is and, more importantly, where 2018 prices are in the futures markets. The U.S. shale drillers need over $50, probably over $52 a barrel for 2018 in order to lock in their drilling costs. They're very underhedged for next year. They're very well hedged for this year. So drilling is likely to continue. We're pretty confident that we see beginning to end of the year, 1 million barrel a day growth in U.S. production. But next year remains very much an open question. If the prices are at 40, then we think U.S. production will slide by about 1 million barrels a day. And if prices are at 60, U.S. production could grow by 1.5 million barrels a day. So the price is the key, and the forward curve is particularly important in that. So that's what we're watching, rig utilization on the one hand, and where calendar year prices are for 2018.
Edward, what's your sense on the OPEC really? Because we've seen them make a lot of effort in sense of output cuts, compliance, including the other oil producers as well. But that really hasn't had the desirable impact on the prices, would you say?
So actually, we think there will be a price rise. OPEC, for all practical purposes, is not really a functioning organization. If you look at the members of OPEC, the ones that count, the ones that can manage their production levels up or down, are Saudi Arabia, the UAE, and Kuwait, and they're doing their job. The rest of them are divided into two groups. There are 5 countries that are particularly big in market power, wittingly or unwittingly. Those are Venezuela, Libya, Nigeria, Iran, and Iraq. And then there are the rest. The rest that include Angola, Algeria, and the like really can't show any growth in production anyway. The ones that we have to focus on are the fragile 5, so long as the Saudis and the Russians have this core agreement to keep oil off the market, which they've just reaffirmed. So going through them, Iraq certainly is producing more than it had claimed it would be producing by a little bit. There is somewhat of a market concern about whether they can reach the level of 5 million barrels a day that the president of the country claims they can. We don't think they can actually get much above where they currently are producing. Then there's Iran, which peaked in its production in February at about 3.8 million barrels a day. They're claiming a 4 million barrel a day target. We actually don't think they'll get there anytime in this year or next year. Libya and Nigeria are the big factors in the market right now because year on year they've increased production by over 1 million barrels a day. That's the surprise in the market. Nobody in January in his right mind or her right mind could have forecast this dramatic return of both Libyan and Nigerian production. But where we are is probably where they would have been, all other things being equal, by 2018. So it's been an acceleration of their production, and it's not going to come back to haunt the market next year because we also, in these cases, don't believe there's more leeway for them to see an increase in production at the levels they were at in 2014. And that leaves, finally, Venezuela, which is actually moving in the other direction and in a constructive way for the markets, unfortunately. But Venezuela is seeing a 30,000 barrel a day drop in production. That's 360,000 barrels a day annualized. They were down almost 300,000 barrels a day last year. They keep sliding, and that's going to be very constructive for the market with some considerable amount of disruption risk there as well.
The other part really is to watch out for is the geopolitical concerns. I mean, we've seen what has happened at the Korea Peninsula. U.S. has been talking about sanctions on Russia. How much of that would be a concern if that actually happens? Because what would happen in Russia would have an impact on the surrounding countries as well.
Well, certainly the sanctions are a factor because you never really know what the outcome of sanctions might be. I'd say the biggest danger of that lot of 3 comes in terms of market impact from Iran, where the U.S. and Iran seem to be in a teasing game. One side on the conservatives, which are clearly powerful in both governments. We see the potential for a breakdown of the JCPOA agreement, and that could affect the oil market. The U.S. still, if it stops waiving sanctions on a claim that Iran has broken the sanctions, could see pressure put on Korea, Japan, the UK, and other countries to, again, drop their imports from Iran, and that could have a positive impact on prices, particularly given the uncertainty over military confrontation between Iranian and U.S. naval vessels in the Gulf. And we had such an incident this past week, and those incidences could get out of hand. There is a risk there.
Well, that's about the crude oil prices, where you are expecting the prices to go higher from here, Ed. But another part really is the dollar weakness, and that really has been a supportive factor in all of this week. We've seen the dollar index trade at a 13-month lows, and the dollar itself has been trading at a 2-year lows versus the Canadian dollar, the euro, and the other high-yielding and the commodity currencies have done quite well too. Would you say that the dollar weakness has been an important factor when it comes to impact on commodities and the kind of gains that we have seen in all of these commodities in this week?
Copper demand has gone up. The spike that we've seen, over 6%, is partly related to the spurt in demand, but also to concerns about restrictions coming in January of 2018 on imports of scrap copper into China. That probably will see a little bit of tapering of the run-up in prices in copper, but basically it's a surprise growth of demand for microwave ovens and other white goods, the surprise growth in auto sales, another copper-intensive area, and the continued insistence of the Chinese government to continue to build out or rebuild out the transmission grid, which is both copper and aluminum intensive. So we think that's kind of more sustainable. And as we look at copper balances, and there's news in the market on that in terms of mines not being able to increase output to meet this new price level, we think the market is actually significantly likely to slide into a mild deficit by the end of this year and a strong deficit next year and an even stronger deficit the year after.
Ed, also, what's your sense on the gold prices? Because while we are up $60 from the kind of lows that we saw in the month of July itself, are you seeing further gains come in from here? Because the kind of global growth numbers that we are looking at, the global equities performing at all-time highs for many of those regions, do you see any money coming back in gold then?
Well, the rest of the year will depend on some unknowns, but basically our base case is for gold not to get much higher than this. We don't think the strength of other currencies against the dollar is likely to continue much further. We think it's basically been capped out. So if that's the case, then this run-up in gold will taper off and settle maybe $30 lower than where it currently is pricing.
All right, so clearly the gains can come in for the crude oil prices and metals as well, but not so much for the precious metals, is the view coming in from Edward Morse. Ed, thank you so much for joining us and making sense of all of those global events and the impact on commodity prices. So, well, that is the view coming in for metals. They are in a sweet spot, but with that, it's time for a short break as well. On the other side, we'll of course discuss the rally in metal prices in detail with Simona Gambarini, who's commodities economist at Capital Economics. On the other side.